Imagine this. You're finally closing your dream home or your next big investment property, and you're excited, right? You locked in a solid mortgage, and then, bam, a year later, your tax bill comes, and it's twice what you expected. Wait, what? But I thought I was getting the same tax breaks as before. Well, you're not. The rules have changed, and you didn't know. Look, if you own a home, invest in real estate, or work in the mortgage industry, you need to know what's coming in 2025. Because for the last few years, you've had some of the biggest tax advantages in real estate history. Homeowners save thousands with mortgage interest deductions. Investors use bonus depreciation to pay little or no taxes. Small business owners, including loan officers, realtors, and landlords, got a 20% tax cut. But in 2025, those tax breaks, well, they start disappearing. And if you don't plan ahead, your next real estate deal could cost you way more than you expected. So before you get caught off guard, drop the word tax in the comments if you've ever been shocked by your tax bill before. So let's break this down. What's changing, who's getting hit the hardest, and how to protect yourself. Back in 2017, the Tax Cuts and the Jobs Act, TCJ, changed everything. Mortgage rates were still low, real estate investing was booming, and tax incentives made homeownership more affordable than ever. Fast forward to 2025. Those tax benefits are set to expire. And if you thought the Fed raising interest rates changed the mortgage game, well, wait until you see what happens when the tax code shifts overnight. So let's get real. If you own property or finance real estate deals, here's what's about to change. And you might want to break out a notepad because this gets interesting. The three biggest tax breaks are disappearing in 2025. If you own property or are looking to buy, these three changes could directly affect your mortgage, your cash flow, and your ability to invest in real estate. Number one is the 20% QBI deduction, the end of the easy tax breaks for realtors, lenders, and investors. If you're self-employed, loan officer, real estate agent, or investor, this was one of the biggest tax hacks ever. It allowed small businesses, LLCs, and rental property owners to write off 20% of their income tax-free. It's like walking into a store and everything is on sale. 20% off, everything. Who's getting hit? Loan officers, realtors, brokers, independent contractors, landlords who own rental properties, self-employed business owners like yourself who qualify for pass-through income. Well, what happens if this disappears? Real estate professionals will see their taxable income jump overnight. Rental property owners could owe thousands more in taxes per year. Have you ever been blindsided by a tax bill? Drop QBI sucks in the comments if you've been hit before. So what can you do? Well, first of all, talk to your accountant, not the H&R guy. Some guy's going to charge you some real money to see if restructuring your business before 2025 makes any sense at all. Look into tax advantage real estate strategies to offset potential losses. Now let's talk about bonus depreciation, why real estate investors have paid almost zero in taxes and why that's changing. Ever wonder why real estate investors seem to build wealth so fast and always driving a Mercedes or a BMW? Well, it's not just about appreciation, it's depreciation. Thanks to bonus depreciation, real estate investors could write off massive amounts of their property's value in year one. Use cost segregation to accelerate deductions and wipe out your taxable income. Turn paper losses into real tax savings, sometimes avoiding income tax entirely. But in 2025, that loophole gets smaller and smaller and smaller and eventually disappears. Now, how does this affect you? If you own rental properties, your tax write-offs are going to shrink. If you use cash flow to qualify for a mortgage, your tax returns might show higher income, which could impact loan approvals. If you plan to buy real estate, waiting until after 2025 could mean you're missing out on major tax benefits. So what should investors do? Well, if you're thinking about buying rental properties, do it now while you can still leverage the tax advantages. If you already own, look into cost segregation study before that window closes. If you ever heard of cost segregation, drop depreciation in the comments below if you've used this before. 3. Mortgage interest deduction and 1031 exchanges, the hidden cost of higher taxes. For homeowners, the mortgage interest tax deduction has been a huge tax saver. Right now, you can deduct interest on mortgages up to $750,000. Reduced taxable income, making homeownership much more affordable. But in 2025, Congress may roll this back even further. For investors, the 1031 exchange is on the chopping block. This is the strategy that lets you sell a property and roll the profits into another one tax-free. Now, if the rules change, investors could face higher capital gains taxes when selling those properties. Less flexibility in upgrading rental portfolios, and fewer options to keep rolling tax-free wealth. If you ever use 1031 exchange, drop that 1031 forever in the comments, please. All right? If you're in the mortgage industry, a real estate investor, or just own a home, these changes will affect you. So here's what you can do right now. If you own property, talk to a tax professional about locking in deductions before 2025. You might want to switch from H&R Block to somebody with a tile hanging outside their office. If you plan on investing, don't wait. Real estate tax laws today are more favorable than they will ever be. And if you're self-employed, explore restructuring your income to protect against tax hikes. Finally, most importantly, stay ahead of the game. Drop a comment below. What's your biggest concern about these tax changes? Make sure you're subscribed because the market is shifting and you need to be prepared.